Can I repay my equity release? Yes. With an equity release plan approved by the Equity Release Council, you can make repayment whenever you like. Some plans allow you to make payments without charges. However, some plans will require you to pay additional fees. Hi, I'm Andy Vickery, one of the equity release advisors here at Money Release. And today, I'm going to give you all the facts you need to know about making payments on your equity release plan. Throughout this guide, we'll be focusing on the most common type of equity release plan, the lifetime mortgage. Currently, lifetime mortgages make up over 99% of the new plans that we recommend. To begin, let's look at how you can make partial repayments towards your equity release plan. With lifetime mortgages, you can make partial repayments at any time you wish. Payment types include cheque, bank transfer, telephone card payment, standing order, and direct debit. You should check with your lender for the latest methods of payments that they currently accept, as they do change over time. Many plans now allow you to make partial repayments free of charge up to a certain percentage of the amount that you borrowed. Typically, this is up to 10% each year. The lenders are affording you the flexibility to pay none, some, or all of the interest accrued on the plan. You could also make payments above interest charged, allowing you to reduce the capital load, and this can save you thousands of pounds when the plan ends. So what happens when you repay your equity release plan in full? Equity release plans are designed to run until the death of the last borrower or when the last borrower moves into long-term care. At the end of the plan, the lender will be repaid for the capital and interest accrued. Despite this, you can make payments against the equity release plan or repay it in full at any point in time. However, when making repayments, you may incur an early repayment charge. Early repayment charges are additional fees charged by your lender for making repayments on the plan outside of any pre-agreed allowances. The charges levied are designed to cover the losses the lender has incurred by you repaying sooner than they expected. Different lenders with different plans levy charges in different ways, so it is essential that you understand any charges associated with your plan. Early repayment charges can either be fixed or variable. What's the difference? The most significant benefit of fixed rate early repayment charges is that you know exactly what rate is charged when you take out your plan, meaning that there are no nasty surprises later if you wish to make payment. The lender Canada Life offer fixed rate early repayment charges on their plans. For example, with some plans they say that they charge 5% in the first 5 years, 3% in years 6 to 8, and nothing from year 9 onwards. With variable rate early repayment charges, you do not know what charges will be levied until you request to make any payment. For example, with Aviva plans, there are currently a maximum early repayment charge of 25% of the initial amount that you borrowed, and the minimum early repayment charge is 0. The amount that is charged is calculated based on movements in gilt redemption yields. A gilt is a government security, and there are a number of different gilts that they use. Where Aviva quote you an early repayment charge, it will be valid for 3 working days, including the day that the figure is quoted. When comparing plans, it's important to know that some lenders base early repayment charges on the initial borrowing, while others calculate it on the current balance outstanding. This could potentially have a significant impact on the early repayment charge that's levied, depending on when you make the payment. For example, let's consider if you borrowed £100,000 with a 5% interest rate. With an early repayment charge of 5% of the initial borrowing, the maximum penalty is £5,000, whereas with an early repayment charge of 5% of the balance outstanding, the maximum penalty after just 4 years is more than £6,000. The easiest way to find out how early repayment charges are levied on your plan are by checking your mortgage contract document or by contacting the lender directly. Once you understand how the charges are calculated, you should know if any charges are likely to be incurred for payments that you're planning to make. An equity release advisor can help you if you're unsure of the charges that the lender will make. At the point of making payments to the lender, you should request details of any charges that they are imposing and by how much you're reducing the balance owed. There are some circumstances in which early repayment charges do not apply. You will never be asked to pay an early repayment charge if you repay following the death of the last borrower or if the last borrower moves into long-term care. We commonly refer to this as the natural term end. If you make payments back on your plan before this, you may incur an early repayment charge. If you believe that you may make payments back on your plan before the natural term end, you should discuss this with your equity release advisor. Many lenders offer plans which allow you to make partial repayments without incurring an early repayment charge. They are often on an informal basis where they enable you to make payments but are not required. We've already discussed how some lenders offer plans which allow up to 10% repayment each year, or some plans allow up to 12% and others even 15%. But this isn't the only difference. Some lenders allow you to make unlimited payments from day one. However, other lenders will set the maximum frequency of payments and require the plan is run for a minimum set amount of time. The next circumstance we're going to talk about is porting your plan. This means that you may transfer your lifetime mortgage to a new property when moving. You can use the sale proceeds of your property to pay your equity release back in full when you move to the new home. However, you may incur an early repayment charge. Moving house doesn't always mean you need to pay your plan back in full though. Instead, you can port your existing plan to the new property. All lenders that are part of the Equity Release Council allow you to do this as long as the new property meets their lending criteria. It is important to consider if the new property is significantly lower in value, your lender may require you to repay part of your mortgage balance. For example, if you were moving to a property which is half the value of your existing property, you may be requested to pay half of the amount owed back to the lender. This is because their security is also halved. This shouldn't be a problem though, as hopefully you will have enough to cover the required payment from the sale proceeds of your existing home. You might have heard of a feature called downsizing protection. It's an excellent exemption offered by some lenders which allows you to pay your equity release back early when you move home without incurring an early repayment charge. As the name suggests, it's often used when you downsize and move to a property that's lower in value. However, it could be that you move to a larger property or a property higher in value. Different lenders have variations for this feature. A notable difference between lenders is that some will only let you downsize when they don't approve the new property. Other lenders allow you to use it at any point regardless. Another difference amongst lenders is that some offer you to be able to use the feature from day one. However, other lenders won't allow it to be used until a set amount of time has passed. It's essential you understand the feature fully for any plan which is recommended to you, and especially if you plan to use it. The Lender One family offers this feature on some of their plans. They say if after 5 years from the original lifetime mortgage completion, you repay your mortgage as a result of selling your property and moving to a different property, they will waive any early repayment charge. There's also another exemption known as the Significant Life Event Exemption. Aviva state that early repayment charges do not apply if you have a joint lifetime mortgage and you repay within 3 years of the date that one of you has died or the date that you notify them that one of you needs long-term care. It's important to remember with all lifetime mortgages, you are not required to make any mandatory payments while you're alive. What's more, all lifetime mortgages approved by the Equity Release Council require that the lender cannot ask for any of the money back early in any circumstance. Even if property prices crash, interest rates spike, or the lender ceases to trade, you will always be able to live in your home for as long as you wish. If you have any further questions, why not visit our website at www.moneyrelease.co.uk and get in touch.